If you add it all up, this is again the slide, 780,000 wafer starts per month per year. On top of that, there's the technological sovereignty and the foundry competition as a result of it, because you will see that multiple companies or more companies are now going into the foundry market in the leading edge, and they are going to distribute across the globe. That will lead to some level of inefficiency. And we assume that if you build across the industry 10% inefficiency on the installed base, then you need about 150,000 wafer starts additional, just to create 10% inefficiency, which is depicted on this slide. Yeah. So to get to an installed wafer capacity, whereby we're able to deal with inefficiency as a result of the geopolitical situation, we need 10% more wafers. And that's a 930,000 wafer starts per month per year increase. Can they afford it? I think yes, they can. That's an earlier slide. But also these are the announced CapEx plans. If you just add up for our 3 largest customers and see where it happens across the globe, then this is $330 billion of announced fabs. I'm not spilling the beans. I mean, this is just public information. That's the global capacity. So it's happening, and it's happening in different parts of the world, as you can see. And that could be a driver, and very likely is going to be a driver from some level of inefficiency. Now, if you believe that 10% inefficiency is too high, you take 5%, which basically you divide 10 by 5, and you know that or by 2, and then you know what about the wafer capacity additions will be if you want to take another number. But it's going to add to the wafer capacity that is needed in the industry. Inefficiency is unavoidable. So we need to expand capacity. I think if we want to grow, we need to expand capacity. And this is just, we all need to realize that we see this very strong long-term growth. We have to add capacity, which is going to be step functions, like we're going from 375 DPV to 600. We have to prepare for cyclicality because we don't predict cycles. Cycles happen because of all kinds of reasons. And of course, we want to balance the interest of our stakeholders, which of course includes very close contact with our customers, with our suppliers, with our investors, and with our people, and with society. So how do we do that? Well, there's 2 ways to add wafer capacity, but just selling more machines. And if you compare the 600 systems per year with the year 2020, you see a 2.5x increase in DUV and a 3x increase in EUV. So that's basically compared with the output 2020. On top of that, we see productivity increase. With DUV, we think we can have on average a 20% productivity increase, and with EUV a 70% productivity increase, which actually gives you a wafer capacity increase in DUV of about 3x and low NA about 5x. And high NA is the first of a kind of a new generation. We need those 20 systems or more than 20 systems in the time frame 2027, 2028. We need to do this, so we're going to expand 65,000 square meters of manufacturing space, which will lead probably to an average capex investment of $500 million per year, which by over 5 years translates to about 200 million euros of depreciation. You could say, if we're all wrong and we've all been dreaming and this growth will not happen, then we will be stuck with 200 million of depreciation because of this expansion. I think that's bearable. I think it's also bearable in the supply chain, which we think need to invest about 2 billion. But for them, of course, the math is about the same. Now, to close off. As again, I hope I was clear on how we see the global trends that fuel semiconductor growth. It's across the entire space. It's in advanced, it's in mature, it's in memory, it's in logic. And that means that we believe that our customers' market could grow around 9% compound annual growth from 2020 to 2030, which needs about 6.5% CAGR growth of the wafers, which in order to be able to ship those machines, we need to up our capacity in DUV from 365 to 600, and to 90 EUV systems and at least 20 high-NA